Happy New Year. Happy New Year, Phenom Group members, investors, traders, strategists, analysts, economists, Wall Street participants, and everyday citizens. Happy New Year. I hope that 2026 proves an awesome year for everybody. Hope God blesses you with health, prosperity, just ample time to spend with friends and family, and just to help others. In that vein, I've got a little free time here on New Year's Day. I thought we'd have a little fun video for the public and see where it takes us. None of this is scripted. For those of you who watched my videos over the years, you know I don't script it. I just I go from screen to screen and we'll see what happens. I had a great year in terms of my I'm sorry, one second. My portfolio performance hit rate, as you can see here. I dropped all the way down to 58% in April, on all the trades that I execute in the Golden Capital portfolio throughout the year. I was able to get it all the way back up to 90%. And you've probably seen my post in social media on X, saying, hey, this is the first time in history, someone with over 2,000 trades completed, as well as every trade or most every trade being, a 1% profit, has achieved a 90% hit rate, in their Charles Schwab brokerage account. It's a partial lie. The reason I say it's a partial lie is because I do this every year. It's just the first time I publicized it. But Charles Schwab knows that this is Seth. This is what he does year in and year out. And I'm just, outlining it, displaying it, if you will, to, once again, suggest it's not a brag thing. You can do this. It's not impossible. In fact, it's the most probabilistic thing to do if you simply follow tried, true, tested disciplines and lean into the highest probability outcomes. The only thing I've blocked out here is the total proceeds. You don't need to see that. But there you have it. We'll move on, see what else, right? A little peek there to show you it's a live screen. Like, this is not a slideshow, so to speak. It's live, folks. So with that, we can move on. I don't have that tab open. Let's go here to, let's go to Twitter. I hope everybody did as well as the market did last year, or 2025. It almost seems funny saying last year already here in the new year 2026, but that is where we are. If you're not a Phenom Group member, if you don't receive our weekly research reports, if you haven't, I'm going to be here again probably in the first half of 2026 saying, well, you should have read my report. You should have read my full year outlook. You should have. And trust me, I'm grateful for those of you who have, but those who haven't are going to likely be found wanting. I say that with confidence because I generally have, pretty precise and accurate, more appropriately practical fiscal outlooks, right? 2026 outlook. If you had read my 2025 outlook, where I forecast the first half of the year correction, if not a flash bear, who forecasts a flash bear market? When have you ever seen that? Again, go back and read my 2025 outlook report. But this is also why I say, if you haven't read my 2026 outlook report, get on it, folks. Just get on it. You can. It's $29.99, I think, a month for our contributor membership level. You can cancel at any time. Like, read it. You like the in-depth analysis. You like the way we outline the probabilities. You like the way that we look at all the impactful details whether it's the fundamentals, the technicals, or the quantitative, even the geopolitical, put that all in a blender to kind of game plan, put together a game plan for expectations as well as what to do, how to position, ahead of the new calendar year. Stick with it. Year in and year out since 2017, I'm literally the only strategist who has, just one, every single price target objective but one we've achieved since 2017 when we started Phenom Group. So with that being said, let's go over to X. We'll do this fun exercise whereby we can kind of go through a lot of my posts. I know sometimes I don't get to answer a lot of the comments within my post, and what I try to do with my social media feed there on X is simply offer the facts. That's why I do a lot of quantitative analysis. It is black and white. Technicals, they lend themselves to a degree of bias and experience, whereby quantitative data it's black and white. If you have reading comprehension skills, it is what it is. But I can understand that even from that perspective. I post a lot of facts that are sometimes lean toward negative price action, if you will, and facts that lead to positive price action. So what do you think, Seth, is often a question I'm asked. So maybe we can flesh that out here in this fun video. Right, January 2026, here we are, or we'll be there the first trading day of January 2026 come Friday. And this is with right now, what we're seeing is so far a negative return with only 2 trading days left in the Santa Claus rally period. And you've probably seen some quantitative data thrown out there in social media, recognizing that we've never had 3 consecutive negative Santa Claus rally period years, right? We haven't had that happen 3 years in a row. And if we can't find some upside here over the next 2 trading days, we're going to have three negative returns during the Santa Claus rally period, three consecutive years of a negative Santa Claus rally period. We'll see what happens. I'm of the opinion that downside is kind of protected. There's limited downside potential absent, something, some headlines, some exogenous or endogenous issue. In fact, I'm tapping the downside at 67.91, not intraday, but a closing basis within the first trading week of, you might want to write this down, right? I said 67.91. So I'm tapping that as the closing basis. We'll be above that after by the end of the first trading week, the full trading week of January 2026. And that's what I mean by there's limited downside. And that number is derived from a quantitative data set that is damn near perfect, forgive my Hebrew, with that being said. So the first thing I have here up on the screen does speak to January returns. And now this is a data set that I came up with back in 2020. So coming out of the pandemic, and I remember Ryan Dietrich, who is a fantastic follow and strategist at the Carson Group, he was putting up the failed. The headline was something like the January barometer isn't anymore. Like it's failed so many times up to that point in 2020. And I was like, when I had looked at it, something stood out to me. Even we did a webinar about this last year, this particular statistic or quantitative pattern that I identified. And yes, I identified. Now I see it all over the place. This year only, I've literally posted this since 2023 on social media. But now, for some reason, I see it all over the place. But But it was what I had noticed from Ryan's post on social media back in 2020, speaking to the failed January barometer, was that there was a pattern. And that pattern was that I recognized was that there were 3 down years in a row, starting in 2008, negative returns in the month of January, 3 down years. Now, in this post by Ryan, there wasn't this column. He was speaking, right, because there were some positive years in there, right? They say as January goes, so goes the year. But in 09, we had a negative January, positive return the year. 10, same thing. 14, 15, 16, all negative January returns, all positive full calendar year returns. 20, 21, 22. Now, these were the only ones in Ryan's data set. And what I had noticed, though, was, wait a second, where's 11, 12, and 13? Where's 17, 18, and 19? Remember, when I saw this was 2020, when Ryan posted it. And so what I quickly realized is these dates weren't in Ryan's post because those were positive January returns. And then I was forced to recognize, wait a second, we've got a pattern here that is pretty significant and repetitive. 3 downs, followed by 3 ups, followed by 3 downs, followed by 3 ups, followed by 3 downs. And so every year in the COVID or post-COVID era, I've been anticipating, right? This is not a forecast. This kind of data is not a forecast, but it helps you to anticipate what you might see, in the month of January so far as returns are concerned. So after 3 up, Januaries here, ending in 2019, I was expecting 2020 to have a negative January return. Same thing in 21, same thing, and wouldn't you know it, that played out. So when 2022 ended, right after that brutal bear market calendar year, I said we should anticipate an up 2023. Why? Because the pattern of threes has been perfect since 2008. I said the same thing in 2024 because we were in or within the 3 up window of this pattern. And I said the same thing in 2025. And you can probably flesh out those tweets from those years where I said, prepare for a positive January. Uh-oh. Because it's ended, right? The 3 up January returns pattern has ended. 3 down, 3 up, 3 down, 3 up, 3 down, 3 up. Now we're going to be in 2026. That's supposed to, if the pattern holds, right? If the pattern doesn't break. We don't know if it's going to break or not. That's why I say this is not a forecast. It's about anticipation, right? How to anticipate based on the trending pattern. 2026, January 2026 is set up to deliver a negative return unless this pattern breaks. And there's a lot of posts out there talking about, well, second term, right? Second term, midterm calendar years are good for January. That can be, that we have data on that as well. January midterm years are positive only 47% of the time. January midterm years. But if it's a second term, right, second term president, right, which President Donald Trump is, this is his second term, it jumps all the way up to an 80% probability, right? We've had 80% of the time in second term, midterm years, the S&P 500 has delivered a positive return, right? So you have, kind of opposing. These are kind of opposing data sets. You say, well, what do I do with that if one says this and the other says that? Be flexible, right? One of these is going to win. Be flexible. If this one turns out to be true, you should always be following the fundamentals anyway. The fundamentals are your guide. You should always have a long-term mindset anyway. If you are getting cheaper prices, if the pattern of threes plays out, great. You're getting cheaper prices. Don't you have cash? Right? Didn't you plan to have a certain amount of cash on the sidelines in case we get a correction in the early, if not the first half, not necessarily first quarter, which maybe happens, but at least the first half of the calendar year? You should have a cash pile. And you should have a game plan for what to do with that cash pile. Right? That's active portfolio management. Right? Down is good to you if you have a game plan, if you have a process. Downside price action is not your enemy, it's your friend. Say, well, Seth, you're a perma bull. I'm right at least 75% of the time on the market, right? I'm positioned appropriately because I'm a long-term investor. I'm always long. But I have a process whereby if there's downside, I can either do some good dollar cost averaging on some of my holdings. I can get new holdings at discounted prices. Right? I don't fear downside if I have a game plan and if I have a process as an investor. All right, let's go through some. I have the whole report, but I only took this snippet for folks. 7,700 by year end 2026. This is UBS. And I know I've only taken this one page out of the totality of their report, which headlines, healthcare as being a top pick, utilities. But within that report, it also does speak to their belief, UBS's belief, that there's going to be continued upside in the tech and AI areas of the market. They're not insinuating that we're going to get to 7,700 on the backs of utilities and healthcare. All right, rarely, so funky word. Rarely does SPX find itself down more than 10% at any point in the calendar year and then finish positive for the year. In fact, it's only happened 6 previous times before 2025. Every single time. The following year delivered a positive return with an average gain of 18%. And you say to yourself, well, this could be the first time that it doesn't deliver a positive return. It certainly can be. It's not the mindset of a savvy investor, though. Okay? Innocent until proven guilty is the way that I've always engaged quantitative data. Innocent until proven guilty. With quantitative data, you're looking to stack the deck in your favor, right? You want to lean into the higher probability outcomes based on the variety of data sets that you include in your research and analytics, right? This is just one data set. You say, well, look at the sample size. As I often have said before, sample size is not a high priority consideration when it comes to quantity. Do you want more? Yeah, of course you want more samples within any data set. But this is not a controlled study like you have in clinical trials and biotech, biopharmaceutical, all that kind of stuff. You can control the sample size. You can't control the sample size of market or economic data. It either happened in the past or it didn't. It's beyond your control. You just have what has happened. And no matter how many times people say, well, it doesn't qualify statistically. If you said that here, you lost. If you said that here, you lost. If you said that here, so on and so on and so on. Like, that's not the best approach when scrutinizing this form of analytics. Sample size is not in your control. We're looking at history to basically understand the probabilities going forward. Biotech, right? One of my favored sectors over the forward 12-month period, and this began in late Q3. I want to say September, maybe even October of 2025. We headlined and offered the research and analytics to our Phenom Group members so far as the healthcare space was concerned, and our overweight and buy rating for the sector. Within the sector, you have, of course, the biotechnology industry, which recently butted up against a longer term resistance level there as well. Keeping in mind that the healthcare sector recently made a new all-time high. I mean, we talk about a parabolic move, and some might say, well, you got lucky, Seth. Your timing was impeccable there with that research and that suggestion or investment idea for Phenom Group members. And what I would say is you create your own luck. There's no luck in cash. You got to put capital to work. Right? And look, we looked at the fundamentals. We looked at what insiders were doing. We looked at the long-term trend of consolidation. We even looked at the technicals and recognized there was an outsized volume indication suggesting washout levels in August of 2025 for the whole of the healthcare sector. We put all of that in a blender. It gave us a buy rating. And, yes, it very quickly went to new all-time highs. It's doing some consolidation here over the last month, the healthcare sector. But if you are inclined to, put that capital in a more beta driver, a greater beta driver sector like industry like biotechnology, the technicals are set up pretty good as well, right? I mean, do you really think it's going to stop there? If you're bullish on the economy going forward, I mean, most sectors, most industries are going to do well, assuming that we're not going into recession. And if we're not going into a recession, more than likely revenues and earnings are going to continue to grow in the 2026 calendar year, which is the consensus analyst estimate or has been, for much of 2025. And still is. I think we're looking at now the most recent full year calendar estimate for earnings is 15% for the S&P 500. If you look at revenues are expected to grow some 5.5–6% for the year. I mean, these are pretty strong numbers, and that's coming off of very strong numbers in 2025. And you might say to yourself, well, everything has to go right. Is the market priced to perfection? Asking a lot of those questions. And what I would say is it doesn't matter if you think the market is priced to perfection or not, if you have a game plan and if you have a process. If you're patient, you have cash on the sidelines, wait for that pullback, right? Wait for that 4, 5, 6, 7, 8, 9, 10% pullback. My call for the first half of the year, again, within our full year 2026 outlook report, is for a correction in the first half of the year. Correction as I define it, doesn't mean everybody else does, but as I define it is 10% or greater, right? A 10% or greater drawdown or correction in the first half of the year. We have several quantitative as well as technical identifiers of the probabilities for that correction to take place as well. Let's see what else here. Yeah, I remember when I posted the Benner cycle, right? And not a lot of people know about this, right? And it's created many decades ago. The Benner cycle informed investors to take profits from the highs in 1999 and 2007 and a strong buying opportunity into 2023. And so when you look at the graphic here of the Benner cycle, you can see that it distinguishes between good years and hard years. Like, that's the key analysis from the Benner cycle. The hard years So 2007 was the last of the good years. Back then, of course, back then. And that was a year for which you, according to the Benner cycle, would have wanted to take profits. Wanted to take profits. Sure enough, we all know what happened in 2008, right? So it nailed the cycle. 2023 was supposed to be the last of the bad years, the last of the bad year or years, right? Because we rarely have, years plural that are bad. You can think of 73, 74, 2001, and 2002, right? Those were consecutive bad years, but it's a rarity. Nonetheless, the cycle does speak to during bad years, you want to be a buyer. It was a good time to buy, a good opportunity. And sure enough, it nailed it. Well, we're getting into 2026, as you can see right there. And the Benner cycle suggests that this is a year for profit taking. It's consistent with, of course, a midterm calendar year, which is also a very truculent, turbulent, volatile year for markets on average. In fact, all but the month of February, I believe, holds a higher average VIX in a midterm year than any of the other calendar years. The VIX is essentially higher every single month but February in a midterm calendar year. Higher than any, whether it's the first year of a new president, the third, or the fourth. It's that midterm year that holds more volatility month after month after month. I think my dog is snoring in the background there. And again, here's some of the, how effective it is, or the hit rate, if you will, from Bank of America within that. NYSE and Nasdaq, big picture, right? So thinking of the technicals here most recently, NYSE is outperforming the Nasdaq. That's not ideal if you're thinking we're going to get double digit. Like, if this is going to be the new trend or trending this way in 2026, the indexes are going to have struggles. Their gains would be muted. Why? Because if the NYSE is outperforming the most heavily weighted index stocks, they're not going higher in unison or together to boost the index, right? The Nasdaq's top 10 stocks are some 25% of the index. The index is weighting, right? The NYSE outperforming is telling you a lot of other stuff is doing well. Which, hey, great, right? We've broadened out the market. People can pick stocks now and things like that. They're not just, the gains aren't as concentrated. Be careful what you wish for. Remember, a lot of that 401k stuff, right? Index ETFs, right? They're not going to do so well. They're not going to do so well. And you don't want to get into a bad habit so far as stock picking is concerned. Stock picking in and of itself is a bad habit, okay? Most years are concentrated gains, right? It's the large cap growth areas. It's the Magnificent Seven that drives the market higher. It's not small and mid caps. They don't have the power. They don't have the power to lift the indexes to the same degree that, if you had large cap growth working, would do. So, I mean, these aren't critical levels in the Nasdaq. It's only a momentary, at this time, it's just momentary outperformance there on the NYSE. But, right, is the characters changing in the market, and going to continue with that character change into the new year. Right. And we can see this. I mean, these are the two biggest sectors and industries within the indexes, whether it's the S&P or the Nasdaq. It's semiconductors and technology. right? They're not making, more and more highs, right? There's a bit of underperformance here. What you have is a lack of market leadership, right? If it's small cap, if it's mid caps, if the equal weight is outperforming, you don't have leadership. And if your suggestion is, well, maybe leadership is just changing, there's no such thing. These are cap weighted indexes. There's no such thing as a leadership change. Technology has led market cycles 87% of the time. There's only 2 cycles that technology didn't lead. Only 2. How can that be? Technology has only existed since the 19. No, not true. Number one, not true. Number two, you can go back to the 1950s. McDonald's was a technology name back then. So, I mean, what is technology today wasn't technology then, right? But 87% of only 2 market cycles were not led by technology. Hence, there's no such thing as leadership change. There's simply particular market cycles whereby technology underperforms. And that's not necessarily a good thing. When you're coming off 3 consecutive years of double-digit returns, and you've got these strategists in and about Wall Street that are forecasting another year of double-digit returns. Like, this has to change. These dynamics between, Nasdaq kind of underperforming, semiconductors not breaking out, technology not making higher highs. This has to, this kind of consolidation here, right? These triangular patterns need to result in breakouts to the upside, or 2026 is going to struggle. Let's see. Do I want to go here? Do I want to? Let's go to this report, Phenom Group, and this was for our contributor and premium members. Right, you have to have a paid subscription to read. And December is my vacation month. We do so once I release the 2026 full year outlook report, which is always the last week of November of a calendar year. So November 2025 is when we release the 2026 outlook report. I go on vacation for the month of December, but in the month of December, we have notes, for our contributor and premium members, things that we believe need to remain front of mind. And when you're, dealing with quantitative data and so many quantitative data sets, the most important need to remain front in mind. So we put a lot of that into our research notes and analytics through the month of December while I'm on vacation. And most of our December reporting is third-party research. So I have all the, I subscribe to Bank of America, Goldman Sachs, JP Morgan, Wells Fargo, Citadel, you name it. I subscribe, to, and it's not because I value above my own analytics. It's a matter of you shouldn't view the markets, you shouldn't view the economy through just one prism. You want to have the understanding of others, their perspective, their opinions, and it will also help you grow as an analyst, as a strategist, as a portfolio manager, as an individual investor. You should never view the market or the macro market through a singular lens. So we offer a lot of third-party research during that time of the year, the month of December. This was Goldman Sachs. These are some of our updated notes on those quants I spoke to. But getting into my outlook for a first half correction. So here's one that speaks to the NASDAQ 100. I had been watching the Nasdaq VIX, right? There's an S&P 500 VIX, there's a bond market VIX, there's also a Nasdaq VIX, and a lot of people aren't familiar with that. Again, experience, right? This is why you do research. This is why you have resources, because you might learn something new. I had been monitoring the Nasdaq VIX like most investors, traders, and given the tech growth concentration of the index, since the Nasdaq VIX jumped above 30. Given the time of year, be it the Nasdaq or S&P 500 VIX, we typically see volatility trend lower in the month of December. That, however, didn't materialize over the first few weeks and into this week, until the last couple of trading days, that is. So I asked Blue Kurtic to perform a quant study whereby the Nasdaq VIX, I had already known the answers, but even so, whereby the Nasdaq VIX rose above 30 and then dropped below 19 for the first time in at least 3 months. The table above outlines the results of this study. As evidence, this type of move from elevated volatility to lower bound volatility in the Nasdaq is a bullish signal since 2004. Across all time frames, prices for the tech-heavy Nasdaq are usually higher, with an 85% positivity rate 3 months forward and 92% positivity rate 12 months forward. The starting date of the study was Friday's close, i.e. the 19th, and closing value for the Nasdaq, 23,307. So that's our baseline, if you will, going out at least 3 months. It's an 85%, so there's 15% probability that the Nasdaq won't close above 23,307. But we're in the business of leaning into higher probabilities, right? Nobody goes to Vegas, playing blackjack, gets 20 and then says, no, I'm out, right? You have the higher probability hand there. All right. Here are some, so I wanted to also go over, we had raised our price target objective in September of last year to 6,800. In short order, it was achieved. And with the understanding that we actually, thought we could, go even higher than that. 1 second. Which we believe higher highs are in store by year end, and remind of our price target objective and time period. Within the and it's a 6-month price target objective. So that'd be October, November, December, January, February, March. Okay. We reiterated this within our 2026 Outlook report. And you're like, Seth, 6,800. Remember, it's a 6-month price target objective. At the end of March, we can look at updating, revising the price target objective, if not even initiating a 12-month price target objective from there. Why was it a 6-month price target objective? Because we achieved our former 12-month price target objective of 61.50 in the first quarter of 2025. In the first quarter. It wasn't until May that we upgraded it to 6,400 plus. Then in September, 6,800. And so we're recognizing what we recognized last year. The market has run far and fast since the correction or technical bear market in April of this year. And so there's a period of digestion that we believe is going to present itself into the new calendar year, into 2026. And so we're keeping this price target objective. But what we also did within our 2026 Outlook report was recognize that all things created equal at Q1 2026 and then initiate a 12-month forward S&P 500 profit objective of 7,600. Now, this isn't cemented either. Again, we've got time on the clock. Right? We've got until the end of Q1. right? We simply think that this is going to be base camp. The 6,800 level is going to be base camp. In and around that is going to be base camp for the Q1 period. If the market outperforms, great. We're long, right? Seth, you're a perma bull. Thank you. I'm long anyway. We're going to do just fine. But if we get that correction sooner rather than later, this still proves prescient. It's a win-win situation. It's a win-win. It's practical and tactical at the same time. So we'll see where things land at the end of Q1 2026. Speaking to the correction, right? Speaking of the Phenom Group 2026 Outlook report, and not everything expected to be rainbows and unicorns, here's a technical quant we had been outlining for months and heading into the November pullback from markets. This helps to remind us that we should be anticipating a correction in 1H 2026, but to use that correction as an opportunity to buy the dip. Again, these are notes that we've extrapolated from our full year 2026 Outlook report that was issued in November. Ample time for our members, for investors, for our partners to go ahead and start taking action and planning and positioning for 2026. So most of you, if you follow me on social media, I've been, ringing the alarm bells when it comes to the high-low logic index, whether it's the NYSE or the Nasdaq. And, more recently in the Q4 period, I again asked Blue Kurtic to run the study. I already know the answer, but presenting it in a structured table is more easily absorbed by readers and investors. When the NYSE High-Low Logic Index rises above 1.6 for the first time in 6 months, here's the max drawdown from, we don't know where the peak is, right? Did the NYSE peak in Q4? We don't know where that peak is, but what we do know is when it does peak, look at the average maximum drawdown from the peak. 17.28%. The median is 19%. The best, right from the peak, the best was still almost 6%. Oh, I'm sorry. Here's a 2.8%. And that was, when was that? 2016. Yeah, 2016. The odds, right? And that's why we use averages and means or medians, right? The odds are that we're going to get that double-digit correction. If only, but right, this is just like I always said, this is just one way of looking at the market and generating probabilities. Just one way. There's others. This one speaks to when the S&P 500's rolling 3-year change or rate of change eclipses 80%. 80%. When that happens, you usually get a double-digit correction. On average, you get, and median, well, median not so much, but from the peak, the 12 months drawdown, average 14.5%, median 10+%. From just the starting point of that 80% level, which would have been September 4th of 2025. So just from the starting date of the signal, you've gained 80% over a 3-year rate, a 3-year rate of change of 80%. You still average a 10% correction. Median is just over 7%. It seems plausible, right? The data seems, again, midterm election years. Midterm election years. Another way to look at it, and what I've always preached to, is midterm election years just have terrible fund flows. The dynamic fund flows, or the dynamics of fund flows, I should say, they're not good. They're just not good. Inflows are much less than any other calendar year. You have much less liquidity, which, again, that's part of the reason you get more volatility. And this chart here from Strategas tells you that very thing, right? This was 2022. That was 2022, a midterm year. The fund flows, 1.2. Look at year 2. It more than doubles. Look at year 3. More than triples. Year 4, huge inflow year. Huge inflow year. If you're not of the opinion that 2025 pulled forward, if there were those flows designated for 2026's midterm year, if you don't believe 5.5 million or trillion, I don't know what that would be, does not pull from 2026's potential, I don't know what to tell you. I would at least have that as a considerable consideration. These are just 3 different ways whereby we can identify the probability, not a guarantee, the probability of a correction in the first half of the year. Just may have many more. We've not touched the 200-day moving average since April. In the S&P, the Nasdaq, the NYSE, we have not revisited, tested the 200-day moving average. If we go through April of 2026 without doing so, again, that's another measure of an overextended price trend. An overextended price trend whereby the probabilities ratchet significantly higher so far as a correction taking place is concerned. I can go on and on. I'm not trying to scare anybody here. I'm just trying to tell you, you can plan for these things, and you want to do that planning in a Q4 period. This is all the kind of stuff you want to be looking at. And it's not necessarily a bad thing. Going into 2025, the reasons that I was projecting a first half correction and or a flash crash were very akin to what we're talking about now. The high-low logic index for the Nasdaq and NYSE elevated, not touching the 200-day moving average the entire calendar year. And wouldn't you know it, there's our correction in the first half of 2025. Like these corrections can be foreseen. They're not guaranteed, but they can be foreseen. You always want to be long the market anyway. It really comes down to, do you have a process whereby no matter what the market throws at you, you can still produce a positive mindset so you can take advantage of cheaper prices? Remember, all of this is being said with a lot of, several tailwinds for the market based on, what we have going on in the macro picture, right? We've got tax refund filing period that is going to be far significantly greater than prior years due to the latest, the 2025 tax reform, tax benefits. We are going to get some type of, I don't think there's a negative outcome from a SCOTUS ruling on tariffs. I don't think, I mean, if you think about it from a game theory standpoint, if SCOTUS strikes down the tariffs, then great. Those that pricing pressure should roll off to some degree. That inflationary pressure should roll off to some degree, even as modest as the inflation impulse from tariffs was in 2025. It should roll off. Secondly, let's say they stay on. We've already dealt. Companies have already adjusted to it. That's what 2025 was all about. So you essentially have status quo. Where's the negative outcome here? Again, the earnings, right? Tailwinds, earnings, right? Those estimates point to another double-digit year of earnings growth. And you say, well, Seth, the estimates are usually wrong. Yeah, they're usually too low. I said that most of last year coming out of Liberation Day in April. I'm like, earnings estimates are going to be found way too low. If we can't find a recession, earning estimates are going to have to go back up and materially. And the analysts have been trying to catch through the remainder of the year. Analysts were trying to catch up. The remainder of 2025, that's all they did was try to constantly raise estimates. You rarely go consecutive quarters whereby the consensus analyst estimate for full year, if not just the quarterly estimates of earnings, are constantly higher. But that's what happened for Q2, Q3, and Q4. And more recently, they've raised the full year earnings per share estimate of 2026 from 13.5 to 14. Yeah. I said, what is it, 14, 15? But yeah, now I remember more concretely, it's 14% earnings growth for 2020. So they're still raising them. Now, we're going to get into the earnings period in just a few weeks here. We've already seen some early results trickle out, like your FedExes and your Nikes. FedEx had a nice response. Nike, not so much. Although Nike beat across the board, but margins, and it's a specific issue, with Nike and because of tariffs. Now, that's the other thing, right? Let's say SCOTUS strikes down. All that money's got to come back to these companies. I've long since said, look, if I'm an S&P 500 company and I know I'm supposed to get my tariff money that I've already paid, if I'm supposed to get that refunded, and I know this president has his trigger finger on social media, I probably want to be in the business of saying, give me all but 90% of what I'm owed. Let the White House let the Treasury keep 10%, just to make sure he doesn't come after my company. So that's what I would be doing. I'm not saying it's the right thing to do. I'm just saying, in this environment, in this climate, that's what I would be doing. So, all right. Here's, again, the Benner cycle we outlined a few weeks ago. All right, so let's get into this and talk again one more time about the midterm election year. This is actually the year. There's 2 years within the 4-year presidential cycle that I can't wait, right? Like I'm a kid in a candy store. I can't wait for it to show up. One of those is the midterm election year, and the other one is year 3 of a 4-year presidential cycle. And this chart outlines the whys, right? We know, or we should know, right? A midterm election year, the average correction is about 17.5%, going back to the 1920s. Like it's a high probability we're going to have a double-digit correction one way or the other. So you're getting a discount. You can get a really good discount in a midterm election year. And you say, well, the last 2 really suck, Seth. And they did. 2018, we had 2 double-digit corrections, right? We had the double-digit correction of 12, 13% in the first quarter of the year. And then in the very last quarter of the year, we had a technical 20% bear market. And the year finished negative, I think 4.5%, 6% on the total return basis. Right? 2018 was a bad midterm year. It was worse in 2022, right? So back-to-back midterm calendar. And we've never had 3 midterm three consecutive midterm years of a negative return. Right, that's never happened before, which sets up a favorable, at least a 1% gain for the S&P 500 in 2026. Right, if that pattern holds, if that historic data holds. But who cares? I don't. And why I say that is because this is the Dow Jones, all midterm years for the Dow Jones. You say, well, we could do the S&P. We've got that data for the S&P 500 as well for our Phenom Group members, as well as those who simply join to get the 2026 Outlook report. Again, if you don't have access to that 2026 Outlook report, you don't have the best data in the industry, guaranteed. I said it, prove me wrong. I'll give you your money back. I don't need your money. Prove me wrong. So with that, this is the Dow Jones every midterm election year, right? The date's right here in this column. Okay, this is the midterm year low value, the midterm year low value. And here is the gain off of that midterm year low. Number one, there's no negative returns here. If you bought the midterm year low and you held it to the high of the following year, hence there's no negative returns here. So yeah, 12 months forward, at least, you have a positive return. The average. So if you're thinking about, hey, where do I want to put that cash? Where do I want to put that cash in the midterm election year? And just, a little bit at a time, right? Because you don't know where the low is. In real time, we're not going to know where the low is. My plan would be to say, look, if we have a Dow, at least a 5% pullback, that's where I would start. Let's say I have 25% cash on the sidelines already, in place for 2026. We get the first 5% pullback in the Dow. I'm going to leverage in 1% of that cash. Goes down another 2, 3. You have to make the tranches how you feel comfortable, but that's how I would play it, right? Because my return to the high of the following year is at least 46%, on average 46%, I should say. Let's find the worst. Let's find the worst in this column. The worst is 23, 19. That's the worst you could do, is get a 20% return on that capital, right? Let's say it goes down a full 20%, the Dow. What if the Dow goes down a full 20%? You started at 5%, right? Your first tranche, your first buy the dip moment using this data was at a 5% pullback, which basically guarantees you, right? If the worst you could ever do was 19%, every single dollar you've allocated to this strategy based on this data will prove profitable. It's just those first tranches are not going to generate as much. That last tranche, you're going to get the full 20%. That's why I say, midterm calendar year could be volatile. Good. Bring it. Bring it on. Give me those discounts, because I have guarantees on the opposite side of that. If you don't like using that language, I get it. I also don't care what people like. History, this is practically guaranteed. Well, history is not a guarantee of future results. If you said that here, at what point are we just saying stuff to say stuff? History is not a guarantee of future results. Go away. Say it to somebody else. That's your bad discipline. You're not leaning into the higher probabilities. That is not a good enough reason to avoid this type of practical game plan. All right, I think we're getting close to the end of our rope here, folks. I head out with my family. I hope you enjoyed, some of this video. Anything else interesting real quickly? Christmas week, I guess we'll end it here, right? I mean, we were up Christmas week roughly 1.5%. And when you've had at least a 1.4% gain during Christmas week, the following week, the S&P 500 was up 93.75% of the time. Let's call it 94. There was only one loss. We need the next 2 trading days to go really well. Or we're going to have the second time in history that this data doesn't quite work out. As a quantitative investor, it's going to happen. It happens every now and then that the higher probabilities don't play out. It happens. It doesn't mean you lose the discipline. It doesn't mean you stop, using quantitative data. We've had, I think, about 4 or 5 data sets not play out to the highest probability outcomes in 2025 from the work that we do at Phenom Group. About 4 or 5 of our studies didn't pan out to the higher probabilities. Of about 110 studies, right? Lean into the higher probabilities, folks. Just because one doesn't pan out, most of them do. Let's see. 4-year presidential cycle. Nasdaq is the weakest link, right? We looked at the charts, technology, semiconductors, the Nasdaq itself. It's setting up that way. These are not the best setups for a new calendar year. But a lot of people know. Sometimes it becomes a self-fulfilling prophecy. And that's what feeds the fund flows, right? If people know this, the fund flows are scheduled as such. Hence, the fund flows tend to suck in midterm calendar years. Your heavier weighted, your growth doesn't do as well as year 1, year 2, year 3, year 1, year 3, or year 4 of a presidential cycle. Again, all this data is about averages. How often do we actually hit the average on the nose? All right, talk about that. I think this was one more I do want to, because this was really good data also by Subu. He speaks to the S&P 500 average percent return in a president's second term, right? We talked about that earlier, a second term midterm year. And right, this just looks beautiful on the surface. This looks beautiful, right? Look at all these positive monthly returns. And even the 1-year max drawdown, look, right? This doesn't match up what we just talked about at all, right? I mean, the worst is 5.7%. Keep in mind, a 1-year max drawdown is from the start of the calendar year, not the peak to trough move, right? We don't know that the peak of the calendar year is on day 1, January, what would for us is going to be January 2nd. We don't know that, right? That's why discerning the peak to trough, as opposed to the starting point of the year, is a more practical way, in my opinion, my humble opinion, is a more practical way to look at the potential drawdowns, max drawdowns in a midterm year, which is highlighted here in orange. And so when we look at the max drawdowns from peak to trough, right, days from peak, how long does it take? Also, this is how long it takes. In midterm years, there doesn't take very long, 19 days, 26 days, 31, 17, 15. It doesn't take very long. And midterm year drawdowns are a bit worse, right? When we look at it, all of them, but even the midterm years highlighted in orange, 9%, 19% right there, 7%, 7%. So it's a different way, in my opinion, a more practical way than just, hey, January 2nd, the first trading day of the calendar year, i.e. 1-year max drawdown. All right, I hope you enjoyed this video. I hope we had a little bit of fun here, folks. Have a fantastic 2026. If you need anything, be in touch and be on the lookout for our inaugural 2026 macro market research report at Phenom Group. I believe is going to be due out the second Sunday of January. Take care, everybody.